Everyone give it up for Dan Neville, CFO of Ascend Wellness. Dan, come on onto the stage. Give it up, everyone.
Hi, all. My name is Dan Neville. I'm CFO of Ascend Wellness. Before we start today, if we could flip to the next slide. Oh, got a clicker here.
Next.
Here we go. Okay, this is the safe harbor statement. So I just ask everyone to read this for a minute, pay attention to the cautionary language and the forward-looking statements that we may make today. So before we dive into the investment thesis and some of our recent progress to date, I just wanted to provide an overview of the company for any of the folks here who are new to the story. Ascend Wellness was founded in 2018 with 3 employees. We're up to about 1,400 today. We're a multi-state operator that operates in Illinois, Michigan, New Jersey, Massachusetts, Ohio, and most recently we entered New York. We've got 19 open dispensaries today and a market cap of around $1.5 billion. And we ended the quarter in Q2 with $104 million of cash and equivalents on the balance sheet. So we have a pretty strong balance sheet. Subsequent to quarter end, we also entered into a $210 million term loan facility. This is a 4-year piece of paper. It was done at a 9.5% interest rate, and we have a $65 million expansion option associated with the facility. This was a really good outcome for us. We took our weighted average cost of debt from 15% down to 9.5%, and it also allowed us the expansion feature to pursue accretive M&A. The other thing I'd say is that the use of proceeds for this simplified our capital structure tremendously. We refinanced all of our outstanding debt and also pre-funded the MedMen New York acquisition. And we'll use excess proceeds and the expansion feature to pursue additional M&A and expansion. So this is the Ascend investment thesis. We call ourselves MSO 2.0 because we didn't go out and make state applications into various states. We chose each of the markets we operated in, and we went out and we acquired what we think is the best portfolio out of M&A out there. If you look at the states that we're operating in, Illinois, Ohio, Massachusetts, New Jersey, and soon New York, they're among the best states that exist. And we focused on limited license states and trying to achieve scale in each of these states. We believe that by achieving scale and targeting a top 5 position in each of the states we operate in, that a bigger piece of the pie will flow towards the larger scale operators in each of these states. Secondly, we focus on flagship locations on the retail side. We believe that A+ retail locations, high traffic counts, 100 parking spots in main retail corridors will have a competitive advantage over time as additional competition enters the market. So we focused on flagship locations. We have a flagship in downtown Boston. We have 4 stores in the Chicago area. We'll have 3 stores in the northern New Jersey area and the MedMen New York flagship on 5th Avenue. We believe that these assets will earn higher returns than your average store across the portfolio. And so we focused on putting in the hard work to get these assets licensed and permitted. Next, we have a disciplined capital allocation strategy. Abner and myself come from a finance background. We're extremely focused on judiciously deploying capital and going after opportunities that have a high return on invested capital. We've grown aggressively through M&A, through sort of a roll-up strategy. We believe this is the best way to operate in an industry that has significant regulatory barriers to entry and time barriers to entry. Time matters in this industry. Being early in early stage adult use markets pays dividends down the line, as we're seeing in Illinois. Next, we have a management team in place that is laser focused on execution and scaling up this business. Got experience across capital markets, cannabis, traditional retail, as well as regulatory compliance and permitting expertise that enables us to execute against this plan. And finally, I'd say we have continued room for additional revenue growth and margin expansion. We're still turning on these assets. We've only got about 30% of our cultivation capacity online today. We've got 19 stores online, and we'll be at 26 by the end of 2022. So there's still room to kind of move up this step function curve as we turn on additional assets. So this is our footprint. Again, as I had mentioned, we're focused on limited license markets east of the Rockies. So today we're operating in the 6 states that are mentioned here, including the pending acquisition of MedMen New York. Today we have 19 open and operating dispensaries and 90,000 square feet of canopy operational. That number has actually moved up a bit. And we expect to have 27 dispensaries and 285,000 square feet of canopy operational by the end of next year. This portfolio represents our fully licensed, fully financed development pipeline. Outside of the MedMen New York acquisition, these are all assets that are ours, that are closed, and are 100% owned. So this is not a pro forma pipeline with LOIs and things like that. This is what we've got under agreement today. We're executing against the plan to build this out. And we're very pleased to have developed such a robust pipeline in just 3 years. So this just provides a breakdown of the markets that we operate in. We're in 5 of the top 9 rec markets and the top of 3 medical markets. Sorry, not top, one of the top 3 medical markets. Florida is obviously massive. We've ranked these markets based on 2020 illicit as well as legal sales, with the assumption that over time, the illicit market will transition over to the legal market. I think what's more important than population size for each of these markets is the population per dispensary. There are certain markets where you've got a pretty good population base, but there's a ton of competition. You have a dispensary on, every other block. And I think if you look at this metric, it shows you why we're so excited about New York. Just a very limited number of dispensaries that exist today relative to a 20 million person population. It also gives you a clue as to why we're so excited about Massachusetts, our expansion into New Jersey and adult use happening there, as well as our continued position in Illinois. This slide on the other side of things also shows why Michigan is a more competitive market. You just have a lot of dispensaries for not as many people. Well, it's still a big market at $2.8 billion overall. There's just a lot more competition there, which means more pricing competition kind of across the board. Population, by grading ourselves on population per dispensary, that's how we kind of focus our M&A strategy. We believe that, some deals that are out there that are maybe accretive today are maybe not the best option or the best M&A for long-term value creation. You look at New York, you look at New Jersey, those acquisitions were not accretive when we acquired them. We think both of those states are going to drive tremendous value for us over the long term. So these are some of our flagship locations. Happily, all but one of these is now an existing operating location. If you would have talked to us 2 years ago, there would have been more renderings. On the left-hand side of things, you see our Ascend Collinsville store. This is the #1 store in Illinois. It's in the St. Louis area, 18 minutes from St. Louis, one turn off the highway, 100 parking spots. We disclosed previously we do over $50 million in revenue out of that store and 1,300 transactions a day. So that's where we really cut our teeth on high volume, high throughput retail, while still providing a robust and engaging customer experience. And I think that's going to serve us very well as markets like New York and New Jersey move over to recreational sales. It's a very different experience selling medical than it is recreational. Medical is a one-to-one experience. Recreational is more of a high throughput experience, but you also at the same time have to make sure that you're taking care of your medical customers in a different fashion. And that's how we do it in Collinsville, with separate lines and separate processes for our medical customers so that we can engage with them and meet their needs more fulsomely. In the middle left, you'll see our Ascend flagship in downtown Boston. It's literally a block away from TD Garden and the North Station, and minutes from Faneuil Hall. This store was 2 years in the making. As you can imagine, getting a dispensary licensed and permitted in downtown Boston is no easy feat. We opened up that store at the end of April, and we're very happy with just how the overall store turned out and our progress to date there. On the left-hand side, you'll see our stores in the New Jersey area. We have a store in Rochelle Park. It's on I-17, on New Jersey 17, half a mile from the Garden State Plaza. We've got 100 parking spaces there. You know, there's probably 100,000 cars going by a day. So as the market moves over to adult use sales, we expect that to be a great store. And similarly, our Fort Lee location, which is in the Fort Lee Staples, if some of you are familiar with it. It's a minute off the GW Bridge, tons of parking. It's going to be another great store for us in the portfolio when New Jersey flips to rec. We see New Jersey as a very dense, hard to enter market. Having a position in the northern New Jersey region and having stores that we're confident will flip to adult use is a very advantageous position for us. A lot of the townships and towns in northern New Jersey may not make that flip, and so having that position leading into adult use will serve us well. This provides an overview of our pipeline of assets. So far this year, we brought on 5 dispensaries. We're going to open 4 more by early next year. We anticipate closing the MedMen New York transaction by the end of the year, which will cement our entry into the New York market. MedMen operates 4 dispensaries today, 1 in Syracuse, 1 in Buffalo, 1 in Lake Success in Nassau County, and 1 on 5th Avenue in New York, as I had mentioned previously. I'd also note with the canopy expansions, we're moving from 90,000 square feet today to 235,000 square feet around the end of the year. I'll go into that on the next page in terms of the detail. But the important thing to note there is that 3 out of our 4 canopy expansions are expansions of existing facilities. So it's a lot less risky operationally from the genetic side, from the people side, to expand an existing facility than it is to do a greenfield build-out development. So this is our cultivation portfolio. On the upper left, you'll see our berry cultivation. That's a drone shot of it. You'll see the indoor cultivation on the left and the greenhouse on the right. We have cultivation expansions underway in Illinois, Michigan, New Jersey, and Mass, which will take us from 90,000 to 235,000 square feet of canopy by the end of the year. In Illinois today, we currently have 55,000 square foot of indoor, and we're moving to 58 with the greenhouse coming online by the end of the year. And I think this picture is great because it illustrates the scale of our operations in Illinois. When we took over in early 2019, we had the shell on the left, which was just 75,000 square foot of light industrial build with a de minimis amount of canopy. In 2 short years, we've scaled out a full cultivation, manufacturing, and distribution business out of this facility, and are expanding 58,000 square feet into this greenhouse. So the speed with which we move and the scale and size of that facility is kind of the blueprint that we're going to use across the markets that we operate in. On the upper right, you'll see Franklin, New Jersey. We started the expansion of that facility in April. We had the facility planted for the first phase of expansion in July and August. So that just shows the speed at which we move. We went from 2,000 square feet to about 20,000 square feet, and we're having an additional expansion that'll come online around the end of the year. And I think it serves us well, that speed, getting up canopy in early adult use markets. And then lastly, down below, you'll see our Athol, Massachusetts facility, as well as our Lansing cultivation facility. The Athol, Massachusetts build is significantly delayed, but we're almost at the finish line there, and that'll be done by the end of the year as well. And our Lansing, Michigan facility is fully planted. So this just provides an overview of our brands. We're continuing to focus on building a portfolio of brands. We've got 2 in-house brands, Ozone, which is our quality for value brand, and Ozone Reserve, which is our higher end brand. We'll also partner with West Coast brands in the best category. And if you look at the data in April, Ozone was the 2nd highest selling brand in Illinois, ahead of High Supply, Rhythm, Verano, companies that had been in this market for a long time. And we've just focused on getting deliveries to each of our stores and partners on a weekly basis and building out our form factor portfolio. The below slide provides an overview of our M&A strategy. We're focused on 2 things. 1, maximizing our existing footprint, trying to achieve a top 5 position in each of the markets we operate in. We're capped out in Massachusetts and New Jersey on the dispensary side, but we still have 2 dispensaries to go in Illinois and 3 to go in Ohio. And we're focused on getting to those caps and achieving scale in each of those markets. Secondly, we're focused on limited license states in near-term recreational markets or already adult use markets. So states that fit that are Pennsylvania, Arizona, Virginia, Maryland, Connecticut, Rhode Island, Missouri. That's kind of the opportunity set. And I'd say lastly on M&A, if the price isn't right, if there's nothing to do, we don't want to dilute our operation and our ownership in our existing portfolio for an inferior acquisition. So we're going to be patient. We're going to find the right deals. We've been successful thus far. Hopefully we can be going forward. The slide provides an overview of our guidance. We guided to $330 to $350 million of revenue, which represents 130 to 145% revenue growth year on year. And we achieved robust sequential growth in Q2 of 26% sequentially. So we're excited by the growth. We're excited by the opportunity set that we have here. And with that, we only have a couple minutes left, but happy to take any questions.
Any questions?
Do you have any plans for cultivation in New York?
Yes, we expect to build a very large scale cultivation. MedMen New York today it's really a temporary cultivation built out of grow containers. Not a lot of people on site, not a scale facility. We've got plans to go big in New York. Being vertical is going to be important. And so I think you'd fast forward a year and a half, you'd see something that looks like Barrie. And I think importantly, a lot of high paying good jobs. Like we employ 40 people in Barrie, Illinois. We've really turned around that town. We've done the same thing in Athol. It's really important to create jobs for these communities and good high paying jobs.
And that question was about cultivation in New York. Looks like we got a hand raised over there. Guys, remember, we have a microphone right here if you want to walk up so everyone can hear you. But, sir, if you're comfortable shouting, please do so. Can you repeat the question?
Yeah, I couldn't.
How do you handle the federal taxation of dispensaries?
Yeah, 280E is just something that you have to live with, right? You're paying, state and federal tax rates at on your gross profit at the dispensaries. So there.
I'm sorry, could you repeat that again?
Yeah. So you can't deduct any of your operating expenses at the dispensary. At the cultivation level, given that that's a production facility and it's a plant touching facility, there is a lot more deductibility there. So we're able to deduct our rent expense associated with the sale leasebacks. Basically, any expense that's running through the cultivation outside of expenses related to your sale or distribution business, you have the ability to deduct it. And we're, I hate paying taxes just as much as everyone else. So we're, very focused on this and looking at various strategies just to try to reduce our 280E tax burden over time.
That's all we have.
Well, when you have a $50 million dispensary, your labor you're fighting to keep it at 10% of sales. Your gross margin is 45%. So SG&A is, SG&A is 12% or so. You're making high 30s margins. Like, that's why flagship dispensaries are so important. It's hard to make money and after-tax cash flow in a $3, $4, $5 million dispensary. When you have a $20 million box, $30 million box, you're able to leverage your SG&A and your employees' expenses, and therefore cash flow those assets pretty nicely. So it's a problem for competitive states. It's not as much of a problem for big boxes like we have with, I think we have $14 million average sales across our dispensary portfolio, including the medical footprint. It's just a different ballgame relative to assets that you would look at in California or Colorado.
All right, let's give it up for Dan Neville, CFO, Ascend Wellness. Thank you for the questions.
Thanks.